There's a comment I keep getting in one form or another on some of my recent videos. It goes something like this. The county is sitting on an $8 billion budget. If they lose a little bit of property tax, just cut the waste and move on. And that's the most reasonable sounding thing in the world. Yet, it's almost impossible. Not because there isn't any waste, likely there is, because of where the money lives. Your county does not have one big checkbook. It has dozens of separate accounts, most of them locked by law to a specific purpose, and the money cannot move between them. So when someone says, just cut the waste and cover the tax cut, they're picturing a big bank account that doesn't exist. Today, I'm going to show you how the money actually flows, where it comes from, which accounts it's trapped in, and why a tax cut that sounds so simple lands on exactly the one account that has nowhere to hide. Once you see the plumbing, this whole debate looks different, and it's more interesting than either side is telling you. Let's go. 2 ground rules first. Number 1, every hard number here comes from Orange County's adopted budget and the state's own revenue estimates. Where I'm doing my own math, I'll say so. Number 2, this amendment does not touch school taxes at all. They're carved out completely. I know that's the thing a lot of you are angriest about, and I'm not brushing it off. It's just a separate system run by a separate board, and it's a whole separate fight, one that I'm going to give a lot of attention to next year. Today is only the non-school side, because that's the only side this amendment changes. Here's the timing. Up front, because it's the number one thing that people ask. If this passes in November, the homestead exemption on non-school taxes goes from about $50,000 today to $150,000 in 2027, and then $250,000 in 2028, and then after on. It phases in. It's not a switch that flips the morning after the election. So let's actually open the books. When most people picture the county budget, they picture a single big bank account. Money goes in, the commissioners decide how to spend it, money goes out. One pot. If that were true, a tax cut would be simple. Trim a little here, shift a little there, done. But it's not one pot. It's a row of separate accounts, and by law, most of them are locked into a specific purpose. When you pay the gas tax at the pump, that money goes into an account that can only build and maintain roads. By state statute, the county cannot move it. When a tourist pays the tax on a hotel room, and in Orange County, that account pulls in over $360 million a year. That money is locked into tourism, convention center, marketing, venues, things like that. The commissioners cannot vote to spend it on a deputy. When a developer pays an impact fee, it can only build the new infrastructure that the growth requires. Your water bill funds the water system and nothing else. None of these accounts can be opened up and poured into general spending. That's not a loophole or a failure. It is the design. And if you don't trust your local government with $1, this is the part that should matter to you. Those locks aren't protecting the politicians. They are the leash on them. This is the mechanism that stops the commissioner from taking the money you paid at the gas pump and spending it on their pet project across town. You want them boxed in like this. The day these locks come off is the day just move the money around becomes real, and I don't want to live in that county. But that same design has a consequence that people miss. If almost every account is locked, then everything that isn't a road, a hotel tax, or a water pipe, things like the sheriff, the jails, the courts, the parks, the libraries, the safety net, all of it has to come out of the one account that isn't locked.
That account is called the general fund. At about $1.7 billion, it's the single biggest account. But it's still only about a fifth of that $8.3 billion budget. The rest sits in accounts the commissioners can't freely touch. What makes the general fund different isn't its size. It's that this is the one big account they can actually spend at their own discretion.
That's where everything flexible lives. In Orange County, the general fund has about $1.73 billion. but most of that isn't money the county freely controls. Strip out the one-time money, last year's leftover balance, plus dollars that are already spoken for, and the recurring money that the fund actually generates on its own is about $986 million. And of that $986 million, roughly $950 million, about 91%, comes from one source, your property tax. Not tourism, not sales tax, not the theme parks. Inside that one flexible account, there is essentially one engine, and it's your property tax. All that famous Orange County revenue diversity that you hear about, it is real, but it lives in those locked accounts. The flexible account runs on your property tax bill and almost nothing else. Now, before we get to the cut, I have to deal with the thing a lot of you are typing in the comments right now, the DOGE audit. The state's efficiency office went through Orange County's books and says it found waste. And look, there may well be waste. It's almost guaranteed. Our tax dollars can absolutely be spent more wisely. I'm not here to defend the county, but just cut the waste runs into two walls, and you need to see both. First, we don't have the audit's fund-by-fund breakdown, so I can't tell you how much of what they flagged sits in the locked accounts versus the flexible one. And that matters because waste in a locked account doesn't help you here. Recovering a wasted dollar in the water utility doesn't free it up for the general fund. It's still locked. It goes back where it came from. Second, and this is the messy part, say the waste is in the general fund, the flexible account, the one that this tax cut drains. That's the money that could take the pressure off. So why isn't just cut it the easy answer everyone thinks? Because one person's waste is another person's essential service. That fight doesn't happen in an audit report. It happens in a budget hearing, line by line, with someone defending every single dollar. The waste might be real. Cutting it's still a war, not a demand. So hold on to that, because cut is about to come back as the county's first option, and now you know why it's harder than it sounds. Now, what does this amendment cost the county? Here's where I have to be careful about where a number comes from. The state's revenue estimating conference built the underlying property data last fall. That part is official. But the state didn't stamp a final per county number for this exact amendment, because the impact legally depends on the November vote. So the Florida Association of Counties took the state's own data and ran the county-by-county math on it. By their estimate for Orange County government, all the non-school levies added together, the $250,000 exemption cost them about $253 million a year. Add the slower growth cap on the commercial and rental property, and it's about a $288 million cut. State data, county association's math, and it covers the whole county, the general fund plus the fire district and other levies. Now, let me narrow that down to just the general fund, the one flexible checkbook that we've been talking about, because nobody, not the state, not the county association, breaks it down that far. So this next figure is mine. I took that countywide number and backed out the general fund share of it. The hit to the flexible account lands somewhere around $145 to $150 million a year once the exemption is fully in. That's my math based on their numbers, the general fund slice of the countywide total. I'm not asking you to take my word for it. I put the whole method and the links to every source in a one-page breakdown you can download. The link's in the description. Check my work. Let me know if I'm wrong, but you better bring receipts if you do, because I'll check your math. Either way you slice it, $145 million out of a recurring $986 million. That's about $1 in every $7 the flexible account brings in, gone every year, and growing because the exemption indexes to inflation after 2029. And remember those locks. The tourism money can't cross over. Gas tax can't cross over. The rest is committed elsewhere. There is no second engine in that account. So the county is left with a math problem and only a few ways to solve it. Here's where the rubber hits the road. The county has three main ways to make that number balance, plus one smaller one we'll get to. and each lands on you differently. Option 1, cut. Spend less out of the flexible account. And this is exactly the cut the waste move from the top of the video. Now that you know what that actually means. It's a line-by-line budget fight, not a demand. And you might assume the amendment forces those cuts to protect police and fire. It doesn't. I read the enrolled text. It says property tax should fund core services, public safety, infrastructure, and the like. And the ballot summary you'll read in the booth says the money must be used solely for those things. But buried in the same section is a clause that lets the county commission keep funding basically anything it already funds, as long as there's no other law that bans it. So in practice, there's no hard wall. The commission decides what shrinks. Could be library hours, could be parks, could be behavioral health and homelessness programs. That's a $179 million line all by itself. The point is, nobody at the state level is deciding that for you. Your county commission is. The gap between what the ballot says solely and what the text actually allows is exactly what a lawsuit filed in Leon County this June is fighting about. I'm tracking that along with all the rest of this noise. If they cut, here's your cost. You keep the tax savings, but some of those things at the county get smaller, and you won't feel it until the day you need one of those things that got cut. Option 2, raise the millage rate. Push the property tax rate up to collect back what the exemption gave away. They can legally do this. Orange County's flexible account rate is only about 4 mils, and the state cap is 10, so there's plenty of room. But watch who actually pays when they do. You just got a huge chunk of your home's value exempted. Your neighbor's rental across the street didn't. The commercial building down the road didn't. Somebody who buys a home in 2027 and beyond doesn't. So when the rate goes up to refill the account, the people carrying most of that increase are landlords, businesses, and new arrivals, not the homesteaded owner who just got the break. You could see your rate rise and still pay less than you do today. The cost here lands hardest on renters and businesses. And the renters don't own the exemption, so they eat it with none of the upside. Option 3, and this is the one to watch, the fee that ignores your exemption entirely. It's called a non-ad valorem special assessment, a flat charge per property for a specific service: fire, stormwater, garbage. Look at the bottom of your own tax bill, the notice that shows up in August. There's a section for these, separate from the value-added taxes. Here's why it's the county's most likely move. It's flat, so it doesn't care about your home's value that just got exempted. It charges you directly. And it's easy. No rate hike headline. Now, the law does put a limit on it. An assessment has to pay for a real service that actually benefits your property. And it has to be sized to what that service costs. The county can't just invent a general fund fee and sweep it in. Courts will throw those out as taxes in disguise. But fire and stormwater are real services that pass that test, which is exactly why counties reach for them. A small rural county west of here, Levy, has funded fire service this way for years. It's proven, it's legal, and it's already on the books. And here's the sting in the assessment, especially if you're a first-time buyer or you bought at the lower end of the market. It's flat. A $400 fire assessment is a rounding error on $1 million house. On a $150,000 starter home, it's real money. The exemption was pitched as help for regular homeowners. The flat assessment lands hardest on the smallest homes. Now, some of you are already typing it. Can't they just jack up some fee and shovel the extra money into the general fund? For most fees, no. And I just told you why. The law caps a fee at what the service costs. But there's one more lever, and it's worth naming because it's the exact one people assume is easy. The utility tax on your power and water bill is general purpose money. A county can raise it and move it into the flexible account. It's real. It's just small next to the $145 million hole. It's bounded and capped at 10% by state law. It takes a public vote, and it's printed on your bill every single month. So it's a lever, and it's a small one, and it's highly visible. So look at what we've actually got. The property tax goes down. That part is real. Roughly $2,000 a year back on a mid-priced home. But every route the county has to make its budget balance points the cost somewhere else. Cut and you lose services you already paid for. Raise the rate and it shifts onto renters and businesses. Use the assessment and it circles right back onto your bill through a different line, hitting the cheapest homes the hardest. Which brings us back to where we started. Just cut the waste and move on. Now you can see why it's not a small thing you do without thought. This amendment doesn't erase the cost of running your county. It moves it off the property tax line and toward a budget fight or a millage vote or an assessment or a county with fewer services. The total bill for local government doesn't vanish because one line item on your tax statement got smaller. And that's the thing worth thinking through. For years, the county budget was a black box nobody read. This amendment does one thing the budget process never could. It puts a number on your own bill that you're going to feel. And a number that you feel is a number you might finally go check. The county's books are public. The millage vote is public. The assessment roll is public. The hearings are open. And most years, almost nobody shows up. The decision about which of these three levers your county pulls isn't happening in Tallahassee. It's happening at your county commission, in a room you're allowed to walk into. Whatever you vote in November, that's the room where it actually gets decided what your bill looks like on the other side. If this is the breakdown you've been looking for, the actual pages, not the yard sign version, subscribe. The school tax side is a separate fight, and it's getting a lot of my attention next year, if that's the one you're waiting for. That's when we get into it. Meanwhile, I'm tracking that Leon County lawsuit and the county by county numbers all the way to November. So tell me in the comments, and be specific, which of the three do you think your county pulls? The cut, the rate hike, or the assessment? And tell me which county you're in. I read most of them. This has been the Florida Real Estate Insider. I'm still Tom McNamara. I'll see you in the next one.